Hi, I'd like to welcome all of you to this video on imbalance and how to identify imbalance. So firstly, I would like to start with the definition of imbalance. If you go ahead and search imbalance on Google, it will give you a definition. Lack of proportion or relation between corresponding things. Now, how do we apply that to the FX markets? Well, simply, how we interpret imbalance is that we use the efficient market hypothesis. Now, that's a really big word, and basically what it says is that for every buyer there must be a willing seller, and for every seller there must be a willing buyer, which makes sense, right? You can't buy something if nobody's willing to sell to you. Now, this is where it gets tricky in the FX markets because, well, any market to be fair, well, because if there aren't any willing retail buyers or sellers in an area, an institution has to take the opposite side of a position. So I'm using an example on NZD Chef that we actually took this trade, and that's why I'm using the example. Now, what we saw was this area of imbalance that formed over here, right? So we can identify this imbalance really easily. And why? How do we identify imbalance? Basically, we look for areas on the chart where we only had buying or where we only had selling. So in this area, we only had rapid buying. How do we know that? There aren't any wicks covering up the candles. So we only had buying in this area. So an institution would have to fill your order if you bought up in this area. All retail traders buying up, an institution has to fill your order. Now, what does that mean? That means while the market is rising, they are taking sell positions. They're taking the other side of your position. Now, they don't want to do that. Why don't they want to do that? Well, simply because they would be in drawdown or losing money. Now, we identified this area of imbalance on NZD Chef because there was only buying in this area, no selling. Now, what we did was we marked out the imbalance fill, and we waited for a schematic to form in this area at the imbalance fill. So as you can see, price filled imbalance and then reversed, and this happens all the time in the FX markets. Let's take another example up here. We had rapid selling, right? We didn't have an efficient market, so institutions had to take buy positions as retail, etc. was taking a sell position. So they are in drawdown, so they're going to try and bring price back up to fill the imbalance in order to close their positions at break even or in profit. Now, if we look at this imbalance here, we clearly see this is our last point of buying, and after that we only had selling. Now we simply fill that imbalance and then the market can continue down. That's basically how to identify imbalance and why it works. Now, we tend to miss a lot of imbalance on the charts, and what we did was we developed a system to help you guys never miss an imbalance on the charts. So basically what we did is we created the system where an indicator will identify all the imbalance on the chart for you. As you can see here, it points out every area that is imbalanced on the chart, and that's simple. How do we know it's an imbalance? Well, it's simple to see. We had all of the selling, right, and then we had rapid buying, and this area is imbalanced because there are no wicks covering it, so we only had buying in this area. Same for this area. Now, if we look, what happens when we fill imbalances, simply we trade into that imbalance and then we reverse. It's as easy as that. So having this tool is extremely helpful to us. Same here, we had that imbalance, as you can see, and we traded into it, and then the market continued down. And this is how we use imbalance in our trading every single day. It's a really useful product, and if you have any more questions relating to imbalance or anything else, feel free to send us a message on Telegram. The links will be in the description of this video. Have a great day.